Amazon has felt recession-proof. When the COVID hit, Amazon stock soared. Why? People couldn't go to the store anymore. So how do they get stuff? They buy on Amazon. Guys, my fiance and I joke all the time about how every Amazon delivery guy has to be so annoyed with us because we will literally order 5 things in one morning to be delivered later on. They come in 3 different deliveries because we might sit there and say, why go to the store instead of doing this? So Amazon has a lot of potential there on growth still. They still occupy about 50% of all online sales, which is incredible. But since COVID, total online sales has dropped. Now that's understandable because during COVID, online sales were the only way to shop for a while. But still, a long-term trend. If you put a gun to my head and said, Paul, 10 years from now, will there be more sales online than there are today? As a percentage of all retail sales, I would say yes. I look back even at shows that I watched from 07 and 08, and they'll show people lined up in malls. And I'm like, man, I don't go to the malls and feel that anymore. Like you go to the mall, and it's not empty necessarily, but there's definitely less people there. I see a lot more mall walkers than I used to. Maybe because they're more prevalent versus others, but this is all part of the way the economy is going. But Amazon also has AWS, Amazon Web Services, which is growing significantly. But even though they have a high margin in it, it's also got a lot of competition. Google, Microsoft, Oracle, they all do their own cloud-based computing and they're all growing like crazy. So let's use our 8-pillar process to check it out. So if you're new to this channel, I'm Paul. I'm a value investor. I use my 8-pillar process to screen out companies to then determine what companies to buy and what price to pay. I use our stock analyzer tool, which is our most important aspect to our software here, to take the future assumptions on a company and decide what I should pay for it today based on very high level look at it. So let's go pull up the 8 pillars now on Amazon. And if you belong to our software, obviously please follow along because it's awesome stuff. And how about I type in properly? Amazon. All right. So let's go through our 8-pillar process. Pillar number 1, we want the 5-year PE ratio under 22.5. So we go here on the main page, 5-year PE, 88. Okay, expensive. Last 1-year PE is 110. All right, pillar number 2, we want the 5-year return on invested capital greater than 9%. We go right here, oh boy, 2.6%. That's an X. But I will say, their last year's free cash flow was a negative $30 billion. That drastically reduced their 5-year average. So factor that in there. You have to sit there and look at that and say, this does not tell the whole story. And I'm glad we're looking at that for that reason. So far we have 2 X's. Pillar number 3, very simply, I just want revenue growth over the last 5 years. So I go to our income statement on our software and I look at 5 years ago, $208 billion. Last year, $485. Massive check mark. But look at the growth during COVID. This was the tail end of COVID. This was the start of COVID. This is the tail end of it. Look at that big jump in revenue. I'm hoping they made money because for a while there, Amazon was not making money on selling goods online. As much as you might not believe that, it is true. For a couple of years there, they were only making money off AWS. Pillar number 4, we want net income growth over the last 5 years. So we scroll down here and we look at 5 years ago, 6.3 billion. Last year, 11.6. Check mark there. And watch this, guys. They went 6, 12, 13, almost 30, back down to 11, okay? That's the earnings. Pillar number 5, we want shares outstanding staying the same or decreasing. Now, this is the silent killer investing. What a lot of companies will do to raise capital is they will increase the shares outstanding and get that money to go grow. It's better than taking on debt when you're an expensive company. So I highly probably guess that Amazon has probably issued more shares in the last 5 years. So I scroll down to the very bottom, and sure enough, the end of the 6th year, 9.58 billion. Last year, 10.18. So that's an X, but I was correct. They have been issuing shares, about 600 million extra shares at an average price of, let's say, $1,000. That's a lot of money. What is that? $60 billion? No, more than that. Is that even correct? Oh, sorry. They did a stock split. I am wrong. So 600 million times an average price of, call it 50 or 60 bucks. That's significant money. That's $30 billion extra in money in their pocket that if the stock falls to 50, they don't owe any money back. They still got their full boat. So keep that in mind going forward. It is a silent killer for stocks. You are getting diluted as an owner. Pillar number 6 has to do with long-term liabilities. Debt works for a company the same way it works for you personally. If you had $10 million in debt versus 0, what's more likely to cause financial troubles? 10 million, of course. Same thing with a company. So for a company, what's a reasonable amount of debt that's good for a company? Well, what I decided was, I go back to our main page, I take our 5-year average free cash flow, $7 billion, and multiply by 5, $35 billion. I want their total long-term liabilities to be under $35 billion. So I go to our balance sheet and I scroll all the way to the bottom, and total long-term liabilities are 148. That's an X. Now, remember, their free cash flow dropped a lot last year. So let's say it was still $15 billion. It's still 10 times their average free cash flow. So that is still an issue, but Amazon's growing very fast and they might be okay with that debt, especially considering long-term capital lease obligations. They built a lot of warehouses. They could have a lot of debt on there for leases. I would still factor that in there as growth potential and the fact that you need to take those debts on. So it's not necessarily just purely debt on the company. It also has real estate behind it, which isn't a terrible thing. But again, part of understanding the process is understanding what is behind that long-term capital lease obligation. Now, pillars 7 and 8 have to do with free cash flow. Free cash flow is the lifeblood of a business. It's cash from operations less your capital expenditures. So there are 5 things you can do with free cash flow: buy back shares, pay down debt, pay a dividend, invest back in yourself, and make acquisitions. You can do all 5, none of them, one of them, any combination you want. But these are the 5 things you can do with free cash flow. So let's go to our cash flow statement. Pillar number 7 is we want to see cash flow growth over the last 5 years. And for our software, the only place you'll find it, we added the free cash flow line to make the numbers easy for you. But spoiler alert, I'm going to show you in 1 minute how you can get all this data I just showed you on one tab. Last 5 years, $8.8 billion to a loss of 30. So it's an X. But guys, look at this. They had a big drop in cash from operations because of changes in working capital, and that's $25 billion of there. And they had a huge increase in capital expenditures. They went from $13 billion to $65 billion in capital expenditures. They are growing like crazy. So it might not necessarily be a bad thing that they're doing this. So one key is, what are these capital expenditures being spent on? They might be spending for future growth, which is awesome for a company like this, right? Our final metric. Now it's a little skewed here, but we take the 5-year average free cash flow of $7 billion and multiply by 22.5 to get a ratio, a value to be similar to the 5-year PE. So 7 times 22.5 is 140 and 14 is 154, 157.5. We want the market cap under $157.5 billion. Guys, no chance. Go back to the main page. The current market cap is 1.28 trillion. So as I told you, here's the 8 pillars tab, and it gives you everything right here. Their 5-year PE is 88. Their 5-year price of free cash flow is 180. They have shares increasing and lots of debt. There's a lot of things here that aren't feeling good. But remember, this is based on the past. And if Amazon has a great future and a lot of growth potential, what could happen there? So let's go to our analyst estimates tab. It's going to tell us what analysts are saying about Amazon. So currently, our data provider provides us with 54 analyst estimates. Now, one thing to keep in mind, look at what they're doing here. They expect Amazon to barely make money this year for the full year, ending December 2022. But look at this growth they have. 27 analysts expect them to make an average of $25 per share in 5 years. So there's a lot of growth potential here for that. Let's go to revenue growth. Almost doubling. Loads double-digit revenue growth for analysts. Okay. So there's a lot of growth potential here for the company. At $24 a share in 5 years, that's some pretty big numbers. I'm trying to think. So 24 times 10 billion, are they expecting 240 billion? Is that correct? How many shares outstanding do they have right now? They have 10 billion shares outstanding. And if analysts expect them to make $25 per share, that's a huge number. I look at this thinking to myself, this seems like a fluke. I might alter this to $12 just to be conservative, which is $120 billion in profit on almost $1 trillion in revenue. That makes sense. That's more likely to be the case. So let's go to our stock analyzer tool. Because at the end of the day, all we're trying to do here is understand the value today based on the future, but we don't know the future. We can just make assumptions. So what I've done is I created a stock analyzer tool that allows me to do low, middle, and high assumptions for revenue growth, profit margin, free cash flow margin, assigning a PE and price of free cash flow, and then deciding what return do I want for those ideas, and it'll tell me what to pay based on that. First things first, I'm doing a 10-year analysis. I can do 1 to 20 here. Now, this is a very important aspect to our software. So please rewind this if you want to understand this more and more as time goes on. So first thing first, revenue growth. As we saw from the analyst estimates, they're expecting low double digits. So I'm going to do that in the high side. I'm going to go 13, middle side 9, low side 5. Now you might think that's too conservative, but again, my goal here is to be conservative. Imagine all the things that have happened just in the last 10 years that we didn't expect or didn't know in other companies. And Amazon has done great so far, but Amazon's not going to be immune to everything in the future. So let's be a little conservative on the low side and aggressive on the high side. Profit margin. Now, I do think the profit margin for Amazon will get better as time goes on. They're going to add more AWS. There's going to become more profitability on the sales side for retail. So I'm going to go with 4% on the low side. Middle side, I'm going to do 7. High side, I'm going to do 10. All right. Now, Free cash flow margin. I'm actually going to do just a little bit less than those because I think they're going to want to reinvest and keep support of their really good moat in the business, in the industry. Now, for PE, the question is, what should the PE be at the end of 10 years? Guys, this is a company that's projected to do $800 billion to $1 trillion in revenue. And you should have a high PE if you have a high moat, which it will have, and also a lot of growth potential. 10 years from now, how much more growth potential do they have? They're still going to grow, but it's going to be much slower. If you doubt that, go look at Apple. Apple's projected revenue growth for the next 5 years is low to middle single-digit growth, 3 to 5% a year. It's not big. Why? Because they've already grown a ton. So you have to be very cautious here. I'm going to go with 13, 16, and 19 for both PE and price of free cash flow. If you think those are too low, I understand. But go look at history. No company sells at a high PE for a long time, and the larger and larger companies have lower PEs over long periods of time. And the market average is 15. So this is still giving a premium to Amazon. Now, finally, for my desired return, the more desired return I want, the less price I have to pay. So the higher my percentage, the lower the price will be. Now, I've already made conservative assumptions here, so I'm going to be less. I'm going to have a lower number on desired return. I can get 9 or 10% by investing in the market. So to get a margin of safety, I'm going to do 12.5%. I'm going to do 15 for the middle. Actually, I'm going to do 14 for the middle, and I'm going to do 15.5 for the high side because I want a bigger margin of safety as I make higher and higher assumptions. That just makes sense to me. If I'm making more aggressive assumptions, they're less likely to be true, so I need a bigger margin of safety for that. I'm going to hit the Analyze button. Now, guys, the Analyze button below is going to give me 6 numbers. Low, middle, and high for PE, and low, middle, and high for price to free cash flow. Okay? My goal, if they're all green, is not to go out and buy Amazon. It's to go verify these numbers. Are these numbers accurate? And there's a few ways to do that. First way is go out there and see what analysts are saying. Go read their reports. Go see what other people are saying about Amazon. Go read the pro and con case on Amazon. Find somebody who's pro Amazon and find somebody who's against Amazon. Look at their reports. See what makes most sense to you. But finally, and probably one of the best ways, is join our community. For less than a cup of coffee per day, there are thousands and thousands of people in here talking every day. And you better believe they're talking about Amazon. That's a very important factor in our community. People still love Amazon. I love Amazon as a company. The question is, do I love the stock? And there'll be a point when the stock is, if it's not today, it'll be in the future. So be ready anyhow. Don't be afraid to do some research and understand the company, because the more you learn, the less you fear. I have learned that over and over in my life. The more I understand a situation, the less I fear it. So I hit the Analyze button, and here are the prices. Low side, 20 to 25. High side, 100 to 115. Middle, about 50 or 60. Now, I put it on my watch list for $50, but I'm actually going to change that to 60 right now. And the reason being is, by the time it gets there, the fundamentals have probably gotten better, and I want to make sure I do the research then so I can go out there and buy and sell puts. Now, this is a great way of looking at the company, but this is not the whole story. I need you to watch this next video about our 8-pillar process so you can understand in more detail why you have to have some sort of process like ours to understand investing. Thank you very much for your time.